Hi, this is David Dickens. Today we are going to talk about whether or not wealthy taxpayers should do Roth contributions or just stick with IRA contributions. We'll talk through a little bit of math, not a lot of math, not a lot of numbers. Hopefully this is a really helpful episode for the younger and the older people in our listening audience. So I'll go get Walter and we'll get started.
Do you need help protecting your finances as you enter retirement? David Dickens of KC Financial Advisors has got you covered. Welcome to the Cover Your Assets KC podcast.
Well, thanks for joining us again here on Cover Your Assets KC. Find us online at coveryourassetskc.com. I'm Walter Storholt alongside David Dickens, based in Overland Park and serving the Kansas City area, but from wherever you are. Glad to have you joining us in on today's episode. If you have questions for David, never hesitate to reach out and ask those questions. And it's a really good topic today because it's something that, David, I've always kind of had a little bit of a hard time understanding when you get close to that threshold of, limits and income of Roths and IRAs and all those kinds of things, and trying to figure out, all right, what makes the most sense to pull the trigger on, and where should I direct those dollars? And so I'm glad we're going to get to the bottom of this on today's episode. But before we dive into all of that, first of all, just hello, and I hope you're doing well.
I am doing great. We were just chatting a little bit before we went on air, and we were talking about our 4th of July plans. I am headed to probably hot, steamy, sunny Dallas.
It'll be hot.
To hang with grandson and other families. And you, on the other hand, are going to a rural mountain retreat in Colorado where maybe you'll just see bears.
Yeah, they said in the Airbnb booking to make sure you lock your doors because bears roam through the area at night checking the doors to see if they're unlocked or not. So that should be pretty fun. I'm looking at the extended forecast for Dallas, by the way.
Uh-oh.
And
do I want to know this?
At the time of our recording, the forecast goes out to Wednesday the 3rd, and the high is exactly 100 right now, predicted. So
okay, well, you know
there
what?
You go.
Strange as it may sound, that could be worse.
100's better than 101, right?
Yes, it is. The hotter it gets down there, the less humidity you get. So, probably 103 is better than 96.
Okay, all right. I like
There's
that.
a silver lining, Walter. There's a silver lining in everything. You just got to dig around a little bit.
Yeah. I like your mentality. I like the way you're taking that. So,
my glass is half full.
Silver linings are great. So, yes, I think you and I both take a glass half full approach here on the show. So that's wonderful. Can we find where the glass is half full in this Roth contribution versus regular IRA, and what should wealthy taxpayers choose and do? Can we find some glass half full items in this discussion, I wonder?
I'll just bet we can.
Okay, wonderful.
We're certainly going to equip our listeners to make good decisions for themselves. Nothing we say today is a recommendation to you specifically, but I think we'll give you some good information as to how you can make really good choices for yourself and your family as you go through your working life and once you're done. So we're going to start with Roth contributions. Then we're going to morph into a little bit of a discussion of Roth conversions. So there are two ways to get money into a Roth. And but it's going to be geared mostly to people who are doing well in their careers and making a bunch of money. So that's
Okay.
where we're going today.
So you couched it as wealthy taxpayers. Would it be wise to kind of define that a little bit? Like who indeed is this applying to? That success? Can we put any sort of metrics around that?
Yeah, and that's probably a really good place to start. To make a Roth contribution, you have to have earned income. So you got to be working at something. You can't make a Roth contribution when you're retired. So what does wealthy mean? Well, it's probably more accurate to say what we're talking about here is a high earning individual. So everybody's definition of, the more you make, the more you think everybody else makes. But I'm going to call a high earner as someone in either the 32% tax bracket, the 35% tax bracket, or the 37% tax bracket. So, for instance, a lot of times I just gravitate to married filing joint. Obviously, singles, I'll try to throw that in as well. But if you are married filing joint and you have taxable income of over $384,000, then that money is in the 32% tax bracket. If you have taxable income over $487,000, that's in the 35% bracket. And if you happen to have taxable income over $731,000, That's in the 37% tax bracket. So those are really the people I'm talking about today. High earners. If you're single, that's 192,000 rounded up in the 32% bracket, 244,000 in the 35% bracket, and 609,000 is where the 37% bracket starts. So those are the folks that are sitting there thinking to themselves, when I do my 401k contribution this year, should I put it in the Roth 401k or the regular 401k? And so the answer to that is this. What you have to try to figure out is how much income are you going to have every year when you retire? And if that puts you in the same or higher tax bracket than you're in right now, then you should absolutely do the Roth. If it's the same or lower, then you should do the IRA and take the tax deduction now. And then if you think it's going to be the same, then it's kind of a coin flip, because it really doesn't matter if it's truly the same, except if Congress raises tax rates sometime over the next 5, 10, 15, 20, 25 years, the time when you are retired. So that's the main crux of which way you go on your contributions. The IRA, just to state the obvious, is tax deferred. You get a tax deduction now. Let's say you put 30 grand, which is roughly the maximum you can put in this year, into your 401k. And then let's say you made 300 grand. Well, the IRS doesn't even get to see the 30,000 you put into the IRA. So instead of them thinking you made 300 grand, they think you made 270 grand. You get the tax deduction now, but the IRS is your partner in that account. And all I mean by that is every penny that comes out of that IRA when you retire, whenever you take it out, is fully taxed as if it were a paycheck. Ordinary income. There are no long-term capital gain treatment. There's no goodies at all. It's just regular old income. And those required distributions start at 73. Conversely, if you put money in a Roth, that is tax-free forever. It grows tax-free. You take money out tax-free, but you don't get the deduction now. So again, that $300,000 earner, they put $30,000 into their Roth 401k at work. Well, the IRS taxes them on the entire 300 grand of their earnings. So how in the world do you know what your income is going to be when you retire?
That's hard to project even just a couple of years, let alone if you are a younger listener trying to figure all that out.
It is really difficult.
That's like when I look, David, at some of those projections, and they're like, you're going to need $8 million to retire. It's like, all right. I understand inflation's at play here, but it's just a hard number to wrap your brain around sometimes.
So most people know that they can figure out that the IRS, the Social Security Administration, is happy to tell you what they project to be your retirement income, your Social Security income at age 62, age 67, and age 70. And all you got to do is log into ssa.gov and have them help you with that. Maybe you're lucky enough to have a pension. So when you're projecting your retirement income, you got to add a Social Security income. If you have a spouse, add in their Social Security income. You got to add in your pension, and maybe it's super cool that your spouse also has a pension. And then interest and dividends on your non-IRA money. And then what you also have to make a projection of is, how much are my IRAs going to be worth when I'm 73? And how much is my required distribution going to be in the year I turn 73? Rough numbers, your first year, the IRS wants about 3.7% of the balance of all of your IRAs added up. So if you do a little bit of math, figure out how much your Social Security income is going to be, and your pension income, if you have it, and your interest and dividends from your non-IRA money, and your required distributions, that's the tax bracket that you're going to be locked into once you turn 73. And so that is what you're comparing against your tax bracket right now. So it's relatively simple and pretty complex. And it's going to change over time. And the one thing it doesn't include is Congress going to screw up the whole thing by raising tax rates into the future?
It's relatively simple, but pretty complex. I like that. I'm going to start saying that about other things in life. It's relatively simple, but pretty complex.
That is, that's the thing about a lot
That's
of...
like a Yogi Berra-ism or something like that, right?
That is life. So, it's kind of interesting. The Trump tax cuts are set to expire at the end of December 25. And if they do expire, then the 22% bracket today becomes the 25% bracket again. The 24% bracket becomes the 28% bracket. I could go on up, 37% becomes 39.5. And that's if they don't actually increase them over the next decade. Why might they increase them? Well, tax rates are historically low. Walter, you would probably get this question right on a quiz. Do you know the highest marginal tax bracket that we've ever had in the United States?
Oh, it was really high up there, like 90, right?
It was 90%.
Yeah.
There's an old joke. It's probably not a joke. Ronald Reagan said, I can only afford to make two movies a year.
2 movies a year, yeah.
Exactly, because he got $1 million a year. And back then, the 90% bracket started at $2 million.
Right. Why would you keep working at that point?
Why would you keep working? Yeah. So taxes started in 1913. They were 7%. They've been as high as 90%. The 60s and 70s, the top tax bracket was 70%. In 82, it fell to 50%. Currently, we're 37%. Who knows? But I do know, we all know, that we now have a $34 trillion national debt. We know that that's increasing by a couple of trillion every year. I saw a Congressional Budget Office projection that says 34 trillion is going to be 50 trillion in the next decade.
Crazy.
So, one side of the aisle would say, we never have to pay that back. The other side of the aisle would say, whoa, wait a minute. Debt is like rust on your car or cancer in your body. It's eventually going to eat us up. So, you get to make your own decision as a taxpayer. And maybe you say, Dave, this is a great country. And if I get charged a little bit more in taxes, I'm good with that. Now, I'm not that way. And I don't know a lot of, but I know some people that are just like that. But I don't know a lot
But yet
of them.
You're still pretty patriotic, right?
Believe me, Walter, I want to pay every penny that I owe, but not a penny more.
Right.
And so anyway, everybody gets to make their own choice, and this is about making a choice between tax-free and tax-deferred, and which is best for you and your family. And, it helps you end up with a more comfortable lifestyle when you retire if you have more, and maybe a little less comfortable if you have less. So that's whether to do a Roth contribution.
There's a whole nother layer to this, though, right? The conversion rather than a contribution. You can convert money, and does that change all these dynamics?
Well, it sort of does.
It's pretty simple, but still complicated.
Exactly. It's really simple, but totally complicated. So a conversion, most listeners would know, is when you voluntarily take money out of your IRA and move it directly into a Roth. And the only cost of admission for doing that is that you pay taxes on every penny of that at today's rates. If you believe that today's rates are historically low and going higher, then a Roth conversion is something you might want to consider. But the real example I want to mention here, since we're talking about wealthy, high-earning taxpayers who might want to do something before they start taking required distributions, is this particular example. So let's say that a taxpayer retires at age 66. They've been a high earner. They got a big 401k that they just rolled over into an IRA. They got a little Roth. They don't know where they got it, but they got a Roth. They have a pension, maybe a small pension. That person and their spouse are going to get big, juicy Social Security income. But they're retiring at 66, and they're not going to start Social Security till 70 because they want to max that out. They've done that analysis. They say, nope, we're not starting till 70. So between 66 and 70, they also have a nice, big, fat brokerage account that earns interest and dividends. But when you take money out of a brokerage account, that's not like taking money out of an IRA. The IRS doesn't tax you on that. They just tax you on the interest and dividends that you earn. So what this couple is planning to do is for the 4 years before they start taking Social Security, they're going to take money out of their brokerage account, maybe they inherited some money and it's also in a brokerage account, but they're going to take money out of there and they're going to manage their interest, dividends, and this small pension that one of them has to a $50,000 income. They're going to have a lot more income, more spendable money than that, but that's coming out of this brokerage account that's not going to be taxed when it comes out. So 50 grand of taxable income. They have a standard deduction this year of $32,000. So their taxable income, if they don't do any Roth conversions, is 18 grand. But they've already done the calculations and they know that they're going to be in the 24% bracket forever once RMDs start. And they believe that the Trump tax cuts are going to expire and the 24% bracket is going to become 28. So their question when they are 66, 67, 68, and 69, their question is, should we do a Roth conversion while we have artificially low tax rates? And if they were sitting across the desk from me, I would say, it's very likely that I would say, you bet you should, because once you get to be 73, you don't have any choices. The IRS has you exactly where they want you. So in this particular case, they're like, well, we can only stand so much pain. And by the way, we want to stay in the 22% bracket for a reason I'll explain here in just a minute. And the top of the 22% bracket, which I didn't mention earlier, is $201,000. Well, I mentioned they have taxable income artificially low for the next 4 years of 18 grand. That means that they could do $183,000 of Roth conversions each year for the next 4 years. That won't get all of their IRA money into a Roth, but it's going to get $732,000 into a tax-free status by paying a lot lower tax than they are totally convinced they're going to start paying once required distributions start. So for this couple, they did the calculation. They couldn't afford to use the Roth 401k at work while they were working because they were making too much money. But now that they're retired, before Social Security starts, before required minimum distributions start, they have a 4, maybe a little longer year window where they can do Roth conversions while their tax bracket is artificially low. The reason I mentioned they're going to go right on to Medicare, and the reason I mentioned the 22% bracket is that happens to coincide with an IRMA limit, IRMAA. That stands for Income-Related Monthly Adjustment Amount. And what happens with your Medicare is that if you get 1 penny of income over $206,000, married filing joint, $103,000 if you're single, then your Medicare gets a surcharge, a 50% surcharge. Well, I mean, is that the worst thing that could happen? Your Medicare costs you $175 a month. The surcharge is $70 a month. And then Part D, your prescriptions cost another $13 a month. So $175 a month turns into about $258 a month. That's about $1,000 a year of extra tax you would pay if you do Roth conversions into the 24% bracket. So everybody gets to do their own math, but that's one thing you'd want to consider when you violate that little tripwire. You swat your forehead and say, oh, I wish I'd known about that. So one thing to know is IRMA. But I think that's a perfect example. And I have clients that are in the middle of this right now. They retired. I have a couple that retired early and they're doing this. But they retired. They had big IRAs, big 401ks that they rolled over into IRAs. And they're doing a series of Roth conversions such that they are paying their taxes now at a tax bracket that they are totally convinced is going to be lower than the tax bracket they're in at age 73.
That makes for a different dynamic, right? When you have somebody that's convinced of that.
Oh, it makes this decision. There's an old adage in my business: don't pay taxes until the moment that they're absolutely positively due, which has its charms, except If your tax bracket is on sale right now, well, you should take advantage of the sale. And the example I just went through is this couple's tax rate is on sale right now, and they need to take advantage of it before it goes up to a permanently higher plateau.
Yeah, it's kind of like, would you like to buy stocks on sale? Well, yes. Would you like to pay your taxes on sale? Yes. So seems logical. That's the part where it's I guess when you can get to that determination, it's incredibly simple piece of the other side of the coin and also very complicated.
Exactly. So if you believe that tax rates are going down in the future, or I have a lot of clients, the majority of my clients are in a lower tax bracket in retirement than they were when they were working. So this isn't a thing for them unless they're really convinced that Congress is going to get aggressive on tax rates. And that could happen too. But the easy choice is if you do a calculation that says, here's what my taxable income is going to be at age 73 when the required distributions start. That makes it really simple, because I'm not saying that tax rates can't go down, but honestly, I can't build a rational case for that with the size of our national debt and the pace at which we are growing it. At some point, the piper has to be paid, and you're not going to tax people with little bits of money. You're going to tax people with significant assets. And so if you find yourself in the enviable position of having significant assets, you have choices to make before your 73rd birthday. After that, your choices get dramatically diminished.
Seems like it will help a lot of people start to decipher which direction they need to lean in. But with the caveat and the disclaimer, as always, David, where it's hard to make these decisions just from listening to a quick podcast, and it would behoove folks probably to get a full review of their financial plan to truly make the right choice here when it comes to where to contribute or whether to do that conversion or not.
Agreed. And when we do have meetings with people that have done well for themselves, or our clients that have done well for themselves, it's never the discussion about, will I run out of money? It's how can I best steward the money that we've accumulated over the years, and whether that's going to their university when they die, or the Humane Society, or their kids. To those people, it doesn't really matter to whom they're giving it. They want to be good stewards over that money, and part of that stewarding, in their view, is paying every penny of tax they owe, but not a penny more.
It is a great philosophy to have when you're putting together your financial plan, and when you work with an advisor who can help guide you through that path. These are the kinds of mentalities that you want to have in place. And so if you have not gone through a formal planning process, I invite you to certainly go through a complete planning review with David Dickens and the team, and you can have a conversation about where you are right now and where you're headed in the future, and how to make the most of it, how to get there efficiently, and how to make sure that you are going to retire successfully. So if you'd like to get in touch and take advantage of a complimentary financial review and go through that CPR process, you can do that by calling 913-317-1414, 913-317-1414, or go online to coveryourassetskc.com. Lots of good info for you there on the website as well. That's coveryourassetskc.com. David, thank you for all the help on the show today and guiding us through this great conversation. I know this is a little bit of a primer to an additional tax conversation we're going to have on the next episode.
We are. So just to further this a little bit, what we talked about today was what your Roth versus IRA choices mean to you and your spouse. But next time, we're going to talk about how it might impact your heirs. The decisions you make over the remaining years that you're on the earth regarding tax status of your monies, what could that mean to your heirs once you're not here anymore? So hopefully that is going to be a fun, interesting episode as well. And we'll see what it sounds like in 2 weeks.
Yeah, I think that'll be a good one. So put that on your calendar to come back and check us out and listen to that episode, or subscribe and follow us wherever you listen to podcasts, Apple or Spotify, two popular locations where you can follow the show, and you'll get notified of future episodes. So definitely take advantage of that if you are interested in learning more about that next topic and want to find out more episodes here. You can always go back and listen to the library and the archive. We've got lots of really good conversations on everything from IRAs and Roths and taxes and all sorts of good stuff. So go check out all of those previous episodes. Listen to your heart's content. We should have some contest, David, if anyone can prove that they've listened to the previous 249. Today is episode 250, technically, by my number count here, David. So the previous 249 episodes, if someone goes and listens to all of those, we should have like some special prize or something like that.
We should have their head examined.
Or that would be the other solution. If you're that big of a fan, you might have a
I'm just saying.
Good stuff. Well, thanks everybody for joining us. Don't forget to check the description of today's show wherever you're listening and finding it, and you'll find contact information and links to more resources. Until next time, thanks for joining us. For David, I'm Walter. We'll see you again on Cover Your Assets, KC. Advisory services offered through Creative One Wealth, LLC, an investment advisor. KC Financial Advisors and Creative One Wealth, LLC are not affiliated. We are an independent financial services firm helping individuals create retirement strategies using a variety of insurance products to custom suit their needs and objectives. The information and opinions contained in this program have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. They are given for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. This material has been provided by a licensed insurance professional for informational and educational purposes only and is not endorsed or affiliated with the Social Security Administration or any government agency. It is not intended to provide and should not be relied upon for accounting, legal, tax, or investment advice.